Afternoon, everybody. Welcome to Liberty Call. Today is Wednesday, November 8th, 2023. Hope everybody's having a fantastical day out there in the interwebs. It is a gloomy day here in Colorado. The snowstorm has finally arrived. So as opposed to yesterday where it was beautiful and fairly nice and 60, 70 degrees, today the high was 35 and that was like at 9 this morning. It's probably lower than that at this point. But the snow is falling and it is wet and gross and slippery outside. So anyways, like I said, I hope you're having a fantastical day. If you could do me a favor, if it's your first time watching Liberty Call, if you could give me some thumbs up, like, share, subscribes, follows, and press that notification bell. All right, let's get into the numbers for today. Dow Jones was down 0.12%, 39 points, closed at 34,112. S&P 500 barely up 0.13%, closed at 4384. NASDAQ up 0.08, closed at 13,650. The VIX fell 2.57% today. It's at 1443. Canada down 0.23. Brazil down 0.15. And Mexico down 0.32. All right, going over to Western Europe. Germany was up 0.51. The UK down 0.11. France up 0.72. Netherlands down 0.26. Spain up 0.52. Italy up 0.13. Switzerland up 0.23. And Portugal up 0.05. Russian exchanges were split today. The MOEX down 0.03, RTSI up 0.53. And the overnights, the Nikkei in Japan was down 0.26, Australia up 0.26. In China, the Shanghai was down 0.16, Shenzhen Component down 0.04, China 50 down 0.28, DJ Shanghai down 0.14, Hang Seng down 0.48, and the Taiwan weighted was up a third. All right, so markets just kind of, flattish today. I guess some of that steam that folks had and the exuberance from the rally last week after the Fed meeting may have run out of steam at this point. So we shall see what happens. All righty, let's get to today's market recap. Let me resize my screen. All right. U.S. stocks struggle for direction after notching longest win streak in 2 years. Oh, my Lord. U.S. stock markets took a pause on Wednesday following a remarkable winning streak. Both the S&P 500 and NASDAQ extended their gains for the 7th and 8th consecutive days, respectively, marking their longest streak since 2021. The Dow Jones Industrial Average also posted its 7th straight positive day. The resilience comes as investors continue to assess quarterly earnings reports and statements from Federal Reserve officials. Fed Chair Jerome Powell refrained from providing clear hints about the future monetary policy in his opening remarks at the Fed's Statistics Conference on Wednesday. However, he is scheduled to speak as part of a panel on Thursday. Meanwhile, the yield on the 10-year Treasury remained in the red, even as after the U.S. Treasury auctioned $40 billion of 10-year notes at a high yield of 4.519%, which was lower than the prior auction's yield of 4.61%. On the downside, utility and energy stocks experienced declines. Energy stocks were weighed down by falling oil prices, driven by concerns about weakened global energy demand and unexpected surge in U.S. crude inventories. The American Petroleum Institute reported a substantial increase of nearly 12 million barrels of U.S. crude inventories, far exceeding expectations of a 300,000 barrel draw. So they thought they were going to go down by 300,000 barrels, but it actually went up by 12 million. Crazy. Anyways, and these people get paid to do statistics. It's just nuts. All right. In the corporate world, Robinhood Markets, Inc. saw its shares plummet by more than 14% after reporting mixed quarterly results. The company's revenue fell short of estimates, partly due to reduced trading activity and declining user numbers on the trading platform. Robinhood anticipates weaker trading activity in November and December, primarily because of holiday timing, leading to a decrease in its price target by Goldman Sachs. eBay Inc. also faced a minor setback, with its shares declining by more than 2% despite beating Wall Street estimates in its third quarter results. The e-commerce platform forecasted sales for the crucial holiday quarter that were softer than anticipated. On a positive note, Roblox Corp reported a narrower than expected loss in the third quarter, driven by stronger bookings. The online gaming platform also announced plans to offer guidance in the coming year, contributing to a positive performance in its stock. So, kind of a, medium warm day, nothing too exciting, nothing too terrible. So, all right, let's get to some mortgage rate news. U.S. 30-year mortgage rate plunges by most in nearly 16 months. Let's see what they had to say there. All right. The interest rate on the most common type of U.S. residential mortgage experienced a significant drop last week, marking the most substantial decrease in nearly 16 months. The Mortgage Bankers Association reported that in the week ending November 3rd, the average contract on a 30-year fixed-rate mortgage declined by 1/4 percentage point to 7.61%. Reaching its lowest level in about a month. The significant weekly drop was the most pronounced since late July of 22. This decline is a result of a rally in the Treasury market, which caused benchmark yields to decrease and subsequently lower the costs associated with home loans. The second consecutive weekly decline in mortgage rates follows a period of elevated borrowing costs, with 30-year fixed-rate mortgages nearly touching 8% in October. During that time, the yields on the 10-year Treasury note, which serve as a benchmark for U.S. home loan rates, were rising. However, this trend reversed sharply last week after the U.S. Treasury announced that forthcoming debt issuance would be somewhat less than previously anticipated, and the Federal Reserve opted to keep its key overnight policy rate unchanged for a second consecutive meeting. Joel Kahn, the MBA's vice president and deputy chief economist, attributed last week's rate reduction to the U.S. Treasury's issuance update, the Federal Reserve's dovish tone in the November FOMC statement, and data indicating a slower job market. The MBA's mortgage market composite index, which measures the volume of mortgage applications for both home purchases and refinancings of existing loans, increased by 2.5% compared to the previous week, reaching 165.9. While purchase applications rose by 3% on the week, they remain 20% lower than the same period last year, suggesting that potential home buyers are still hesitant despite the decrease in rates. Went down 0.25%. Calm down. Sellers who locked in lower mortgage rates are continuing to hold on to their homes, thereby constraining inventory levels in the housing market. All right, so a little help there. Still high, but it's not obscene by any stretch of the imagination. I mean, like if it was like 15% mortgages, that would be high. All right. Last up comes from our friends over at Mises Wire. It's titled, "There's No Easy Way Out of This Debt Spiral." This was written by Ryan McMacken. Summary here. All right. The U.S. government's fiscal year 2024 has begun. And if the trend persists from the previous year, we can anticipate the government accumulating debt at an alarming rate. In fiscal year 23, which concluded on October 31st, the U.S. government added another $1.7 trillion in debt, marking a $319 billion increase, or 23% more to the than fiscal year 22. Remarkably, this ballooning deficit occurred even though budget watchers had predicted a year-end deficit of $1.5 trillion as recently as June. By the year's end, deficits exceeded expectations by an additional $200 billion. I know, shocking. The rate of increase may have been even higher, as the reported $1.7 trillion figure may involve some accounting maneuvers. Notably, the cancellation of President Biden's student loan forgiveness program was counted as a windfall for federal. It's not a windfall if we don't forgive someone's debt. It's just less money we're spent. Wow, this is some crazy stuff. Let's see here. Okay, excluding this adjustment, the deficit effectively doubled from fiscal year 22 to 23, potentially increasing by 100% instead of the reported 23%. These growing annual deficits are approaching the unprecedented levels seen in 2020 and 2021 when the federal government took on significant debt to mitigate economic crises resulting from government-mandated lockdowns and business closures. Consequently, the national debt, which represents the cumulative total annual deficits, has now surpassed $33 trillion. This is an increase of over $6 trillion since the onset of the COVID-19 pandemic. Put that in quotes, and a staggering $18 trillion since the 2008 financial crisis. The looming challenge lies in the fact that huge deficits are manageable only when interest rates remain exceptionally low. When interest rates rise, servicing the mounting debt consumes a substantial portion of federal revenues. The consequences of this include political difficulties as Congress is forced to reduce spending on popular programs and economic troubles stemming from attempts to suppress interest rates through monetary easing, which can lead to inflation. When has that occurred? Oh, wait, just a few years ago. As of the end of the second quarter, federal interest on the debt had already surged to over $900 billion, exceeding the likely Pentagon budget for 2024. This underscores the impending political and economic challenges. The escalating deficits are particularly concerning as they occur during a period when the economy is purportedly doing well. Yeah. Okay. Historically, deficits tend to stabilize or decrease during economic expansions, making their surge in this period of economic strength unusual. Falling tax revenues combined with persistent spending contribute to the problem, which is expected to exacerbate when the economy enters a recession, probably soon. The conventional response to a recession is to lower interest rates and make government debt more affordable, which they've already done that 3 years ago, and I don't know how they're going to do it again. However, the Federal Reserve faces challenges in manipulating interest rates when the Treasury issues substantial new debt. As the government debt piles up, the Fed must buy a significant portion to prevent interest rates increases, leading to the creation of new money, inflation, and a falling dollar. The outlook for fiscal year 2024 appears to be characterized by increasing deficits and expanding national debt, with $1.8 trillion estimated by the Committee for Responsible Federal Budget, and this figure may prove conservative if economic conditions worsen. Yeah, it's probably going to be over $2 trillion if I had to guess. Anyways, I mean, the only way this really ever stops is if the federal government just collapses. And I mean, that's the only way people are going to get mad enough to just say, enough, quit robbing me of 30 or 40% of what I make. And y'all are out of business. I feel bad for the people who are going to, are expecting federal pensions and veterans benefits. That all goes bye-bye. Sorry. That's just the way it is. Anyways. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening. Me and my boy Jake are going to go play some ball because he's been trapped in the house all day because of the pending snow, which is falling from the sky. So we're going to have to play some indoor time. Anyways, but he's been patient back there. So let's reward him with some fun time. Anyways, hope everyone has a wonderful evening and I shall talk to you guys next time. Adios.